The jobs numbers came in hot. And this caused all sorts of reactions in the market. But when we look under the hood, were things as good as they are? And can one jobs number print like this actually cause some major changes in the trends? Let's dive into this and take a deeper look. Now, quickly, I just want to highlight, I do these every single morning now, Monday through Thursday, keeping you all up to date at the market open. If you're enjoying this, make me a part of your morning routine and get my regular daily updates. So let's dive into this. Let's have a look. The non-farm employment change that was delayed from last week was expected to come in around 66,000, came in at 130,000. So that non-farm payroll number came in hot. This dropping the unemployment rate from 4.4% down to 4.3%. On the surface, it looks like a pretty awesome number. This did cause the US dollar to uptick a little bit, rates to back off a little bit on the markets, and certainly gave a little bit of tailwind to the stock markets. But let's take a little closer look at what these some of the things that I want to observe about these numbers. First of all, this is the non-seasonally adjusted number. What you want to point out here is these January numbers almost always, not almost always have a drop on a non-seasonally adjusted basis. If you look at the actual real payroll drop, you can see it's very consistent over the last 5 years with every other early first few months of the year kind of number. That's because obviously there's a lot of seasonal jobs during the Christmas periods, and then a large amount of unemployment or at least layoffs that come in afterwards. Point is, this entire number is literally seasonally adjusted. And so there's lots of room to try to figure out how much did they actually juice it versus what were the real amount of jobs created. The second thing that was a bomb was that the seasonally adjusted total non-farm payroll for going back to March of last year was revised downwards by close to 900,000 jobs. That basically foobarred the entire numbers for last year. And so, it's one of these things where what's clear is that they're consistently overstating jobs and then go back and revise them backwards. The thing here is, and what we care about as traders, well, what does this mean for us? We're not here to debate as to whether or not it should be this way. It's only what will be the impacts to our trades from this. And so let's look at this a little bit closer. First of all, the stock market is up 45 points on this, but let's look a little bit deeper on some of the key things that are most directly impacted. First of all, the dollar. The dollar was breaking down quite clearly. In fact, let me put this down on a 4-hour chart basis. And coming right down to a Fibonacci zone right before that number, and that payroll number caused a bullish reversal candle to kick in. This is the puzzle to solve. Does this candle fade, or is it actually the beginning of a new little hourly impulse on the upside of the dollar? By the way, I don't think that this is a number that could actually change the bigger picture trends, more about this short-term swing trading path. And so trying to determine here on this daily chart whether the dollar can create a zigzagging kind of formation, retesting some levels like we saw back in December is plausible. But overall, the downtrend in the US dollar is quite dominant. And now that we put in that very critical swing low on the payroll, this becomes the edge of the cliff, where what you basically think is that if the payroll number could not cause the US dollar to hold the line here, and we break any way down below 96.50, you want to think that the dam has been broken open, and the path of least resistance will remain decisively for the US dollar decline. That will manifest itself on numerous currency pairs. You can observe here the euro would continue higher towards 122 to 124 on the upside. It would really solidify the top in the US dollar yen, and potentially drive things like the Canadian dollar higher, as the US CAD may break to fresh, the US dollar would break to 52-week lows, or the Canadian dollar to 52-week highs. There's certainly some interesting currency moves, but the other thing that's very important is Fed path, and where are we with rates. Clearly, we have a new Fed governor coming, a Fed chair coming in with Warsh, and a lot of people trying to determine what's the path of rates from here. Well, what we've seen is in the last 3-4 months, the SOFR futures market, this is the December 2026 contract, which is where will rates come in at the end of the year. And things have been very, very quiet, as there hasn't been very much indication of any big policy shift. And the question really becomes, have we seen a potential new breakout suggesting a more dovish Fed? You can see the jobs number caused this to fade. What I'm curious about here is that will it generally stay above this descending trend line breakout and above that 50-day moving average, or did this payroll number just derail lower rate cycle? See that as well with the long bond. This is the 30-year Treasury bond. What you can observe here is we had a very decisive bull breakout on Treasury bonds, as the long-term interest rates have actually been backing off. The thing is, obviously, this jobs number caused this to fade. But what I love here is that when a jobs numbers like this causes this pause, and it doesn't cause a new sell-off, it will be bought. Think of the way we've been calling things on crude oil. So let's see whether or not this is a new breakout in the long bonds. Lots of super interesting things going on here. So the bigger question, and many of you are asking, is what is in store here for the stock markets? Well, I don't know how much has changed. First of all, the equal weight index continues to rock and roll, and the breadth of the market continues to hold up. The theme that we've been talking about for weeks here on this channel has been sector rotation, has been the dominant theme. And now if you observe here, we have the software sector still actually down on the day and week. When we take a look at the Mag 7s, they haven't been able to retest their 50-day moving average, nor have they even done a basic 50% retracement yet. You can see the 61.8 retrace lies exactly at the 50-day moving average. Point being here, nothing has changed on the sector rotation theme. The point here is that, and I'm very adamant about one point, the only way the S&P 500 is going to 74, 7,500, which is possible, and I'm not trying to say that it's not possible, but in order for that to happen, we are going to need Mag 7 participation. It's 1/3 of the S&P 500 market cap weighted and 2/3 of the NASDAQ 100. You can't have these continue to lag this way and think that there's going to be any upside momentum in the market. Think of it like throwing an anchor off the side of the boat and asking why the boat can't go full speed. Point here, we had to have zero indication that the Mag 7s have joined the party, and therefore, even though we're up on this S&P 500, you still have to be skeptical at this moment. This could still prove to being a very heavy overhead resistance. Maybe the bulls have now walked the market off the edge of the cliff, making a potential downturn, something that's going to happen much later in the month, if not even in March. But it doesn't mean that there's an upside to the market. At the same time, you have a very overbought energy market. You have a very overbought consumer staples market. A lot of the places where that rotation has been coming, it's not that that they imminently have to reverse, but the elastic, think of it, elastic between two fingers, has been stretched so much that there's only so much those sectors are going to be able to help take the S&P 500 higher. And so you really do need Mag 7s to turn up, and it's not happening right now. The last thing I want to touch on here, completely off topic, but I wanted to highlight it because we're trading it quite actively and we'll be focusing on the next day or two, is that crude oil is held the line and is attempting to break out. Don't ignore this. We're going to be turning this into trades. We've been already long for a while, but this is where there's an opportunity, and I want all of the listeners on this channel taking advantage of these things. So this is what I want to leave you with. Listen, I mean, again, do these every single morning. If you're enjoying it, make sure you just join me Monday through Thursday here at 9:30. But those of you that want to see how we turn these ideas actually into trades and make money off them, we do that at Big Picture Trading. I'm going to be live right now in my Where's the Trade session with my Big Picture Trading members, talking about trade ideas and ways to implement these things. You can take a look behind the curtain with a 14-day free trial. All you have to do is go to bigpicturetrading.com and register for a free trial, or click on the link in the description below. When you get in there, what you'll see on the right-hand side is a big orange button that says join now to the Where's the Trade. We'll be live in about 5 minutes with members on there. You can join me, check out what we're doing, and seeing what we're doing. Otherwise, for those of you just here for the channel, have a great trading day, and we'll catch you online tomorrow morning. Thanks, everyone.